our last example from Chapter 3, we've started with a trial balance. You can see here the subsidiary ledger account balances for the fiscal year ended. And what we're going to do is we're going to prepare a statement of revenues, expenditures, and changes in fund balances for the year. And then we're going to compare a budget to actual so our budgeted amounts and then the actual amounts and the variance. So statement of budget to actual. So the first thing that we're going to look at is a statement of revenues, expenditures, and changes in fund balances. So looking at, of course, how much did we actually receive in, so we see our actual revenues. So we're not looking at estimated revenues. That's going to be for our budget to actual. We're looking in this statement for what are our actual revenues. So I'm going to copy that information for over here. And then our total revenues is, of course, the sum of all of these revenues. We then have our expenditures, so not appropriations, but actual expenditures. So we have the expenditures of the general government. Here, we're going to copy those here. And then you can see this is very similar to an income statement where we have our revenue minus our expenses. We then have different interfund transfers. So we have this $50 transfer out. So we have transferred out $50. So what then we have our changes in our fund balances. So revenues minus expenditures. What is the full change? So we have that there was a change in our fund balance of $31. Then we're going to look at what was the fund on the first of the year, and then what is our fund now with this increase. It's $31,000 because our amounts are in thousands. So it says that assume the beginning fund balance was $152,000 and that the budget was not amended during the year. So our beginning fund balance was $152,000, which therefore our ending fund balance is $31,000 plus $152,000, or $183,000. Okay, so that statement of revenues, expenditures, and changes in fund balances, you can see it's very similar to an income statement for a business where we have revenues minus expenses, and then we have other sources and uses of cash. In this case, we only had a use of financing, then the change in the fund balances. Okay, now the second part of that question is a budget to actual and variance analysis. So when we have our original budget and our final budget, when there would be differences in that is if we had amended the budget during the year. So it says up here that assume the budget was not amended during the year. So there was no change, so the original as final is going to be exactly the same. So we're going to pull down these budgeted amounts. And of course, the original and the final are exactly the same because that was not amended. But if our budget for some reason had been amended during the year, then the original budget and the final budget would not have the same numbers. So we have that information there. Then we're going to look at what were the actual amounts. We have our actual revenues. The actual sum of those revenues. Okay. And then of course we have what is the difference, so of our actual to final budget. And so when we look at that, so we see that we had $3,000 more in taxes, $5,000 more in fines, and $4,000 less in charges and services. There was no variance in our intergovernmental revenue. Now we can look at the expenses. So of course where the budgeted expenditures here and at the beginning and the final are exactly the same because our budget wasn't amended during the year. We have our total expenditures. I'm just going to copy that all the way across for ease. And then we have the actual expenditures. Oh, that's what I pulled down, isn't it? Not the appropriation, but the actual expenditures. So let's fix that to where I pull down the appropriations. And then here I put our actual expenditures. And then the budget to actual variance. And then the excess of revenue over expenditures. So we have total revenues minus total expenditures. So, of course, positive in every instance. And then we have here what's the difference between, so we have positive revenues and we spent $38 less than we had budgeted to spend, and so we have our $4 and we're going to do plus, so we had a $42 excess of revenues over expenditures. We then have that interfund transfer out, which was $50,000 and zero variance. Okay, then we look at what was the excess after we look at our other financing sources and uses. So of course our budgetary, we have a negative amount of $11 for that transfer out. We have a positive for our actual, and then the variance, of course, oh actually the variance, nope, is 20. Okay, so then any changes, the next thing that we have is increases. If we're looking at what is the difference in any encumbrances, any changes to the fund. These encumbrances, of course, remember that that is money that we have locked down that we haven't received yet. So here the increase in fund balances for the year. So we don't have anything here. So our change in fund balances fund balance, of course, being $152,000 on July 1st. Zero variance here. Okay, and then looking at, now I'm seeing that because we should have ended up at a $31 difference, so I'm trying to see what the difference here was between revenues and expenditures and why that is not matching the amount. Okay, 81 being 31. Yep. So then 31 here. Oh, I see what the problem is. So this actual should match 152 plus 31, then should be 183. So budgeted to actual, and then of course the difference being the variance. Okay, so those are the examples for Chapter 3 that should hopefully help you when you're working on the homework and the City of Smithville simulation.